McDonald's, the king of burgers, actually built its empire on something much more solid than a Big Mac: the earth itself. Meanwhile, Starbucks, with its premium coffee and cozy atmosphere, decided not to go down that road and opted to rent everything. Why did one company amass fortunes by buying properties and the other rejected that proven formula? Which strategy generates more wealth in the long run, owning the land or conquering the market at full speed? The answer will surprise you, because it is not as obvious as it seems. Get ready to discover the secret behind two giants who pursued dominance, but in radically opposite ways. Subscribe, like, and comment, as this helps the channel continue to create this type of content. Beginnings. It all started in the 50s when Ray Kroc, a milkshake machine salesman, discovered the McDonald brothers' small restaurant in California. Fascinated by its efficiency, Kroc bought the franchise rights and expanded the chain. But the real genius came from Harry Sonnenborn, his financial advisor. McDonald's is not a hamburger company, it's a real estate company. Instead of just selling food, they bought land and rented it to franchisees, generating stable income and full control. Decades later, Howard Schultz, founder of modern Starbucks, knew this strategy inside out. Inspired by Italian coffees, he acquired the company in 1987 and transformed it into a global empire. However, he deliberately rejected the McDonald's model. He chose to rent rather than buy. Why ignore a formula that has created immense fortunes? Calculated risk or strategic error? What do you think? Would you prefer to invest in land or speed? Tell us in the comments, without obligation, just to chat.
McDonald's, the real estate empire disguised as hamburgers. Ray Kroc, in the 50s, a 52-year-old street vendor who travels the United States selling milkshake machines. One day, he receives an unusual order: 8 machines for a single restaurant in San Bernardino, California. Intrigued, he visits the place and is impressed by the system of brothers Richard and Maurice McDonald: fast, cheap, and consistent burgers. Kroc saw the potential and, in 1954, signed an agreement to franchise the brand. But the hamburger business was not enough. Margins were low, about 1.9% of franchise sales. Enter the genius. Harry J. Sonnenborn, a former vice president of finance at Tasty Freeze, joins Kroc in 1956 and reveals to him the insight that would change everything. Origins of the strategy. Sonnenborn tells Kroc, "We're not in the food business, we're in the real estate business." The key was not to sell fries, but to control the soil beneath restaurants. In 1956, they founded the Franchise Realty Corporation, a subsidiary dedicated to buying land and property. This entity becomes the hidden engine of McDonald's. They identify prime locations, negotiate purchases, and then lease them to franchisees. In this way, McDonald's not only charges royalties on sales, around 4 to 5%, but also a fixed rent for land use, which often exceeds the income from food. Financial model. The scheme is brilliant in its simplicity. McDonald's Corporation acquires the land, sometimes financed by banks or initial investors. Then you select a franchisee who invests their own capital to build and operate the restaurant. In return, the franchisee pays McDonald's a monthly rent based on the value of the land, plus a percentage of sales as royalties. This creates a dual revenue stream, variable from sales and fixed from rent. If the restaurant fails, McDonald's retains ownership and can refranchise it. It is a model of low risk for the corporation and high commitment for the operator. Key advantages. This strategy generates a constant and predictable cash flow, immune to fluctuations in food sales. Provides absolute territorial control. McDonald's decides where to open, avoiding internal competition and securing strategic locations, such as high-traffic corners. Expansion is sustainable because rents finance new acquisitions without diluting capital. And the best part, the valuation of physical assets. Today, in 2026, McDonald's real estate portfolio is worth about $42 billion, with properties in more than 100 countries. This represents a significant portion of its stock market valuation, making it one of the largest commercial real estate owners in the world. Multiplier effect. The cycle is virtuous. Rents generate fresh capital, which is reinvested in more land purchases, allowing for more expansion. What started as a modest 1.9% royalty is multiplied in multiples over real assets. For example, a property bought for $100,000 in the 1960s could be worth millions today, with rents adjusted for inflation. This not only protected McDonald's from crises such as inflation in the 70s or the pandemic, but catapulted it into an empire of more than 40,000 locations. In essence, every Big Mac sold not only generates operating profits, but strengthens a vast real estate portfolio that grows over time. This model, disguised as fast food, has made generations of investors and franchisees millionaires. But why did Starbucks, knowing this formula, choose a completely different path? Let's explore it below.
Starbucks, expansion without ownership. Howard Schultz, a young executive from New York, travels to Milan in 1983 for a housewares fair. There, on the Italian streets, he discovers something that transforms him. Espresso bars are not just places to drink coffee, but vibrant social spaces where people meet, chat, and enjoy a sensory experience. Inspired, he returns to the United States with a vision to replicate that culture in America. At the time, Schultz was working for Starbucks, a small Seattle chain founded in 1971 that sold high-quality coffee beans, but not ready-made beverages. Convinced of the potential, he proposes adding espressos, but the owners reject the idea. Schultz left the company in 1985 and founded Il Giornale, a chain of Italian-style cafes. 2 years later, in 1987, the opportunity arose. The founders of Starbucks decided to sell. Schultz, with investors, buys the brand for $3.8 million and merges Il Giornale with Starbucks, rebranding everything under the iconic mermaid logo. This is how the modern Starbucks was born, with a clear strategy, speed of expansion, obsession with quality, and omnipresent presence in daily life. Schultz's beginning. From the very beginning, Schultz focuses his energy on creating a third place between home and work, a cozy atmosphere with premium coffee. Italian inspiration guides everything, from the menu, lattes, cappuccinos, to the store design. The acquisition and merger with Il Giornale marked the takeoff, from 17 stores in 1987 to ambitious growth plans. The strategy is based on 3 pillars: speed to capture markets, quality in each cup, and presence to become a cultural habit. Rejection of the McDonald's model. Schultz knew the McDonald's model well. In fact, in the first rounds of financing, investors suggested imitating him, buying land to ensure control and generate passive income. They were ready to invest in property, seeing Ray Kroc's real estate success as a foolproof formula. But Schultz rejects the idea out of hand. In his book, Pour Your Heart Into It, he explains that tying equity to real estate would limit agility. Opt for an asset-light approach, renting everything from high street space to airport space and shopping malls.
Reason, execution speed. The decision is pragmatic. Instead of tying up millions on land, Starbucks reinvests in what Schultz sees as essential to differentiating itself. First, opening new stores at a breakneck pace, from hundreds to thousands per year, expanding from coast to coast and then globally. Second, intensive staff training. Baristas not only brew coffee, but create emotional connections, with training programs that cost fortunes but ensure consistency. Third, quality control. From the selection of beans on farms to roasting on their own plants, everything is prioritized over fixed assets. Fourth, marketing and positioning. Campaigns that sell not only coffee, but a lifestyle, with partnerships such as music in stores or mobile apps. This approach frees up capital to innovate, such as launching Frappuccinos or expanding into China, where they now have thousands of locations. Competitive advantage. Being first in each market is key to building brand leadership. Starbucks is getting to key cities quickly, saturating urban areas ahead of competitors. Leasing offers flexibility. They enter premium locations without eternal commitments, test concepts such as drive-thrus, and if a site fails, close without massive losses in properties. This contrasts with McDonald's, whose expansion is slower but anchored in durable assets. For Starbucks, the intangible brand, that green mermaid that evokes convenience, is worth more than bricks. Key cases. Take Chicago in 1989, the first expansion off the West Coast. Stores lost money for 2 years in a row due to a cold market, literally and figuratively, and local competition. Had they bought property, the tied capital would have plunged the company into unsustainable debt, possibly collapsing the expansion. Instead, with leases, they adjusted, persevered, and eventually dominated. By contrast, Los Angeles in the 90s was a triumph. Stores in Beverly Hills and Hollywood attracted immediate visibility, with movie stars as regulars. This boosted pop culture, think movie scenes with lattes in hand, and turned Starbucks into an aspirational icon, accelerating national growth. In short, the expansion, without ownership, allowed Starbucks to scale from a regional chain to a colossus with more than 38,000 stores in 80 countries today. While McDonald's builds wealth on land, Starbucks is committed to agility and expertise. But how do these strategies compare head-to-head? We see it in the next section.
Strategic comparison between McDonald's and Starbucks. Now that we've broken down each giant's strategies, it's time to put them head to head. How do they compare in terms of ownership, expansion, business model, returns, control, and value to investors? Let's break it down step by step, based on key data that reveals why each approach is unique and effective in its own way. First, the ownership of the premises. McDonald's owns about 57% of its land, which means that they directly control a massive portion of its physical assets. This gives them long-term stability, as the land appreciates over time. In contrast, Starbucks opts for leasing in 95% of its stores, freeing up capital for other priorities rather than tying it to real estate. Here, McDonald's plays defense, building a wall of tangible assets, while Starbucks prioritizes mobility. In terms of expansion, McDonald's is growing slowly but steadily. Buying land takes time, negotiations, and startup capital, but it ensures a solid foundation that withstands crises. Starbucks, on the other hand, expands quickly and flexibly. With leases, they can open stores in weeks, invading markets before the competition. Think of it as a tortoise versus a hare. McDonald's wins with consistency, Starbucks with speed to capture urban trends. The business model also diverges. McDonald's is based on franchises, where operators pay rent for land and royalties on sales, creating passive income for the corporation. Starbucks prefers owned stores under leasing, allowing them direct control over the day-to-day operation, from barista training to the menu. They do not depend on third parties to maintain standards. Everything is in-house, although they pay rent to outside landlords. Speaking of returns, McDonald's generates about 8% in real estate, a low but predictable return, like a treasury bond. Starbucks, focused on operations, reaches up to 18% in operating margins, driven by premium sales and efficiency. It's risk versus reward. McDonald's is playing it safe. Starbucks is betting on high growth.
Control is another key point. McDonald's has complete control over locations, deciding where and how to expand without interference. Starbucks, as it depends on landlords, has partial control. They can negotiate terms, but a difficult landlord could complicate renovations or closings. Finally, the value for investors. McDonald's offers its shareholders the role of asset owners, stable dividends from a real estate portfolio valued in billions. Starbucks, as an ideal tenant, attracts outside investors in real estate, signing long leases and paying on time. But the company's shareholders benefit most from the brand and operational growth. In partial conclusion, both strategies are valid, but they pursue different ends. McDonald's builds a lasting empire on bricks and control, ideal for stability. Starbucks chooses agility and branding, perfect for a changing world. It depends on the context. Do you prefer an immovable castle or a fast fleet?
What this means for investors. Now that we've explored the real estate strategies of these two titans, a key question arises for you, astute investor. How can you capitalize on these differences? Let's look at the unique opportunities each model offers, focusing on revenue streams and risks without repeating the fundamentals already covered. Remember, this is not financial advice. Consult an expert before acting. Let's start with McDonald's. As an investor, you have two main avenues: join as a franchisee or buy shares in the parent corporation. If you opt for franchising, you invest significant startup capital, around $1 to $2 million per location, but you indirectly access the company's real estate power. McDonald's retains ownership of the land, charging you rent, which means your profitability depends on operating sales. However, as a shareholder, ticker MCD, you benefit from the hybrid model. Stable income drives juicy dividends. In 2024, they paid $6.68 per share, with a yield of 2.3%. In addition, the appreciation of real estate assets raises the value of the stock in the long term, offering compound growth. It's ideal for those looking for exposure to real estate without managing it directly, with the security of a diversified giant.
In contrast, Starbucks opens doors for outside investors thanks to its asset-light approach. You can't invest directly in their properties as part of the company, ticker SBUX, as they don't own them. But here, the NNN, net leasing model shines, which creates an ecosystem of opportunities in real estate. As a real estate investor, you can buy a pre-built location, often in REIT funds such as Realty Income or Store Capital, where Starbucks signs a 15-20-year contract. Under NNN, the tenant, Starbucks, covers fixed rent, about 6 to 8% of initial yield, taxes, insurance, and maintenance, freeing you from operating expenses. This generates predictable passive income with a low risk of vacancy thanks to the strength of the brand. For example, a store in an urban area could cost $2 to $4 million, but the contract ensures stable cash flow with annual escalations for inflation. It's perfect for diversified portfolios, especially in a market where REITs offer yields of 4 to 6%. The key insight: Starbucks' asset-light democratizes access to premium real estate, attracting funds and individuals looking for yields without the complexity of day-to-day operations. McDonald's, by internalizing everything, limits these external opportunities, but rewards its shareholders with a more robust moat. For you, choose according to your profile. Do you prefer stable corporate dividends or direct passive income from properties? In a world of variable rates, both strategies stand out, but Starbucks expands the game for more players. Which one appeals to you the most? Share in the comments.